How many of you have opened your KiwiSaver app this week and said, wait, where the hell did my money go? Liam Peck is a KiwiSaver expert and is here to explain what is going on and what you need to do to get financial freedom faster.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everybody else do it, hit that subscribe button and get ahead, because this is New Zealand's fastest growing real estate and investment show. Liam Peck is MortgageHQ's KiwiSaver expert, and there's a lot of KiwiSaver volatility right now. Liam, what's going on?
Where do we start? There's obviously a lot happening at the minute. The markets are in a bit of a downturn. There's two kind of different type of market terms that we can look at it right now. You've got a bear and a bull market. Bull market when everything's great, everything's going up. Bear market is when it's going down. A bear market by definition is about 20% drop from the index high. We hit about 10%. Okay, so we're about halfway, I should say, to being in a bear market. However, statistically, when we look at the last 10 years or 5 years, we've already had two bear markets. Okay, so we had March 2020 and January 2022. In history, there's never been 3 consecutive 20% drops within 10 years. We've already had 2 in the last 5. So if it was to continue going down, if it was to continue getting worse and worse and worse and hit that 20%, it'd be the first time in history in 120 odd years with the stock market. So statistically speaking, we should be coming right very shortly. It might get a little bit worse, but I can't imagine it would get much worse.
Should I pull out now or just go full pepper and start stockpiling beans?
I wouldn't say do either of those things. I think pretty much just steer the course. It really depends what your position is. Okay, so there's going to be a different answer for different kind of positions and clients. If you're somebody that is relatively close to using this, that's something that's going to need tailored specific advice. However, if you've got a time horizon, so if you're not touching this for 10, 15, 20, 30 odd years, your best bet is to just stay invested.
So my fund's tanking because Trump's tweeting and Russia is in a Cold War cosplay. That's a pretty solid financial strategy right there.
So when we look at, what drives, how do I word this? When we look at what drives a company's position in the market, if you look internally, there's a thing called a SWOT analysis. Everyone's heard of a SWOT analysis. There are external factors that can affect a company's productivity, and that's primarily going to be measured by a pestle analysis. I'm not going to read them all. It's an anagram, but 2 of the key ones here are political and legal. Okay, and that's 2 key factors that we're talking about when we talk about things like tariffs and geopolitical things like Russia. So essentially, there are big changes happening, tariffs coming in, huge international trade policy that is going to be putting price forward to the consumer. Generally speaking, that speculation in the market is going to cause some discourse in the market where investors pull out, and that's essentially what causes a bit of a drop. So that's what happens when a huge new political or legal piece of legislation comes in. So that's essentially what's happening at the minute.
Being in the wrong fund can cost me hundreds and thousands of dollars, but no one mentioned that over the coffee.
Absolutely not. So yeah, there is obviously a bit of a tidbit when it comes to your $6, $7 coffee a day. However, if we were to look at the main factor that's going to be your financial freedom at retirement and giving you a healthy, wealthy retirement is compound interest. And you build that from the start. You build that from as early as possible. So if you're somebody that has a long time horizon and you're sitting in a main bank default account, you're really losing a lot of that potential for growth.
So stay calm, they said. Is it just my retirement doing cartwheels?
No, it's everything. It is your retirement doing cartwheels in the sense that right now, however, time horizon wise, we need to be looking at the big picture. So if we were to look at a week to week or even a day to day chart, we're obviously going to see big, massive zigzags, right? We zoom out on a year to year or even a decade to decade chart, you're not even going to see those fluctuations.
How is it even legal, Liam, that we can be put into a default fund to start and it bleeds our retirement or robs us from our retirement when everybody else is just happy and swimming along?
I agree, to be honest. So if we were to look at a default account, averages maybe 3 to 4% returns if you're lucky. Okay, it's going to be essentially a balanced mix, so 50% growth assets, income assets. When we talk about what that looks like in comparison to inflation, for example, in 2021 we had a quarter report, it was over 6% inflation, so you're losing dollar value when it comes to the comparison between what a dollar's worth and how much your fund was growing. So I think personally, by law, everyone should at least have the opportunity to sit down with an advisor and make an informed decision from day one, from the moment they're enrolled. Just isn't the case yet.
Why do we only check our balances when our KiwiSaver balances plummet? It's like jumping out of a plane and checking the parachute.
Absolutely. So I think with KiwiSaver, it's very low time commitment, but it's also very hands off. I think as well with KiwiSaver specifically, some people, they're so far away from using it that there's almost a detachment to it being their own actual money. So when things go wrong, you're more compelled to take action, right? It's more of a catalyst for change if things aren't going great. If it's all fine and it's doing okay, or it's just good enough, then there's no actual, catalyst for that change. So that's why I think there's a huge spike in activity with KiwiSaver transfers and things like that when things go wrong, because as I said, it's a catalyst for change.
So I'm thinking of withdrawing. Should I ask a financial advisor or my dog what he thinks?
Financial advisor, day dot. So when it comes to withdrawals, realistically, you should have a structure in place that you've been building towards already, whether that's first-time purchase or retirement. If you're in that kind of position, the fund you should be in, you shouldn't be having a huge effect as is. However, I understand it's not going to be the case for everyone. So end of the day, any type of withdrawal structure, any type of questions or queries, financial advisor is always the way.
I'm questioning my fund's performance. Should I switch or scream?
Yes, both. I think switch depends on where you are, depends on what that's for, depends on what your goals are. You might be in a fund that is underperforming. However, you're not going to know that unless you either go and do the research yourself or go to an advisor and they do that for you, which is free, by the way.
Liam, thanks for joining us.
Cheers, Andy. Thank you for having me.
Just a reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, you just know that someone else is already using this knowledge to make their next deal while you hesitate.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold.